Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life.
Hello and welcome back to the Life by Design podcast. My name is Jay Shalansky, and joining me this week is Doug Walters, Chief Investment Officer here at Strategic. Hey, Doug.
Hey, Jay. How are you?
Fantastic. It's been a little while since we've done one of these.
Yeah, my first time on the couch.
Yeah, our new location has been great. We had Nick on last time, and now Doug, so this is good. I'm glad about it.
Great.
So, I thought I'd take an opportunity. Unfortunately for Doug, I pivoted a little bit before we recorded this podcast because we'll get to the other topic in another cast, but Doug had a great article this week for Insights about gold. And I thought it might be interesting for us to kind of talk about that a little more in depth with gold being so high right now and what that means for investors, what that means for us, how we see that. And so the question I had to start us is, in the article, you talk about gold being up 60% this year. So when you see a move like that, what's going through your mind as a risk manager, as the CIO?
Right. Yeah, I think what's going through my mind, obviously, is has it gone too far? Right. You're always wanting to factor in the moves. Are they exceptional in nature? And are they justified? And what does that mean for potential returns going forward? So those are the kind of questions we're asking internally.
Yeah. And I think, one of the things, too, to start us off specifically about gold is I think a lot of people think of it as more of a safe haven. And in your piece, I think you're kind of saying it's anything but safe.
Right.
Let's tell me what that means.
It's both, right? It is both. It's confusing. And it really, the article went back to this conversation we had about how do we classify gold? We really like the idea in our strategies of classifying things as either growth, they're either adding specifically to growth of the portfolio, or they are protection of some sort. And so where does gold fall in that balance? And we ended up putting it in protection, despite what you've just said, which is it is a risky, volatile asset. So the obvious question is why? How do we end up there?
Yeah, and so I think overall, when you have an asset like that is volatile, how do you find its place in a diverse portfolio?
Right. And I think what we why we have gold and why we call it protection is really how it behaves versus equities. The biggest risk in most portfolios are the equities, right? They go up, they go down. Sometimes they can go down a lot, but what we're shooting for is that long-term positive return. What gold has offered historically is a positive real return, but a return that comes often at different times than equities. And when you are managing a portfolio and trying to manage risk, you want ideally things that go up, but things that zig and zag at different times. And we can get into maybe some of the specifics of why that helps a portfolio in terms of risk and return.
Yeah, I think that would be helpful understanding, why does that correlation exist? I mean, I don't know if we know the why, but there is a correlation there between, what it's equities and gold and why is that happening and the timing, we never try to time things, but why does that timing exist between the zig and the zag?
Right. If you do a study of gold, which we have, looking historically, what you find is correlation is relatively low. Both assets have grown over time, but correlation is low. And it kind of makes sense if you think about it qualitatively. Equities tend to go up when the economy is booming and everyone's excited and corporate profits are high, whereas gold tends to be a place people run to when they're nervous. Right, it is a store of value. If you're concerned about the potential of a downturn in the economy, people tend to pile into gold. It is viewed as a safe haven asset. Even as we said, it is not safe. It goes up and down quite a bit, but people tend to flock to it, and investors tend to flock to it when there's uncertainty. And so it makes a good pair with equities, and that again, it goes up, but it tends to go up at different times.
Okay, this is maybe a strange question, but just as I'm thinking about it, is there some sort of psychological thing there where gold is like actually a tangible physical thing, and sometimes equities are based on performance of or things we don't have in our control, right? It's up to the
Right.
company and how they're doing and how they're selling and what they're going to be valued at, where we know we could see gold. Like if you could go to Costco and buy a gold brick if you wanted, like
Right.
like that's a tangible item that you can get a hold of.
Yeah, I think that's exactly why it is viewed as a safe haven. It has historically had some useful value, right? You can go back a very long ways in time, and gold has been a currency of some form or another. And it is, as you say, a physical object you can hold, you can put it in your pocket, you can hide it under your pillow. Whereas an equity is, it is a little less tangible to the average investor. Ironically, there's, to maybe a CIO like myself, something like an equity actually has a little bit more tangibility behind it. It has earnings, right? It has corporate profits, has future profitability, which you're buying, which has value. Whereas gold, there's no income, there's no real fundamental way to value it. It is just a store of value that has historically been useful for as a store of value.
Yeah. And so when we talk about, I want to bring us back to kind of the portfolio and protection. So when we talk about putting things into protection, and it's about portfolio resilience, what does resilience mean in practice to you when we're talking about that?
Right. I think resilience, I think of it as a whole portfolio view, right? It is both across growth and protection creates that resilience. But the protection within resilience, again, for me, is what is it doing to help offset the risk that is on the growth side? And we can we can size growth versus protection at varying degrees to set different risk levels for different investors. So we can have very aggressive portfolios that have very small allocations to protection, and we can have very conservative portfolios that have very small allocation to equities and growth.
Yeah. So when we're talking about the protection bucket in a portfolio, how can it still contain risky, volatile pieces and still be doing its job, which is protection?
Right. It's really that the zig and the zag that I talked about. If you think about risk in a simple form as volatility, how much something goes up and down.
Mm-hmm.
You think about any stock or equity you might own, it's going to go up, it's going to go down. And then you add another asset like gold that is also going to go up and down and hopefully up over time, but it is going to go up and down at different times. And those, let's say equity is falling, if gold is holding its value or going up, the overall portfolio is not falling as much. So you're reducing the volatility of the overall portfolio and still, hopefully getting the returns that you're seeking. So when you have a diversified portfolio with protection, with growth, even if there are risky assets in protection, if they are not correlated with what is in the growth side, meaning they're not going up and down at the exact same time, they have the potential to smooth those ups and downs.
Got it.
Reduce volatility. And if you consider volatility to be a form of risk, then it's reducing the risk of the portfolio.
So then that makes it more of like a feature and not a bug.
Right. Exactly. It is in there that is exactly why we have it in there. And it is a nice rebalancing lever, we like to say, when equities fall. If gold holds its value, we can sell some gold, buy some equity, participate more on the upside.
Yeah. And so for those maybe folks or investors that are looking as protection, like equating protection with can't lose. How do we? I think that's a great way to address that in a conversation, right? Is like,
Right.
well, that's not what it means. It's just
Right.
it's another lever for us to pull.
Right. Exactly. It is not, there's nothing in protection that can't lose. There are things in there that are less likely to lose. For short-term government bonds, you would hope that they're going to hold their value and pay their income over time.
Yeah.
But gold also, we believe, belongs in that protection sleeve, and it can fall, and it could drag down all that whole protection sleeve into negative territory at times, and that's okay as long as over time it's doing its job.
Yeah, and so let's say that were to happen. What's something you would want folks to remember that if that that starts to, because I mean, it has just been going up for the
Right.
most part, right? I mean, over time, it's
Right.
been going up. And so there could be a downswing at some point. We don't try to predict the future, but there could be.
Right.
And so what should I remember as an investor when that happens?
We should remember how much it went up the last few years. That would be number one. So looking at, not focusing on the short term is
Right.
really what we're saying.
Yeah.
Thinking long term, and you can think long term by looking back over history and seeing the value of that something like gold has added to the portfolio, and not worrying if it does pull back, which eventually it will. It can't go up forever, just like equities will not go up forever. We have these ups and downs. They happen. Let's look back at the history and make sure we're doing, and gold is doing what we want it to be doing in that portfolio over time.
Yeah, and I think, kind of wrapping it up here, and this is something we've talked about before, is, hopefully this episode educates you. But really the idea is, if you're a client of ours, that we're watching that for you.
Right.
And that opportunistic rebalancing, there's methods behind the madness, quote unquote, of why things are going into the different buckets and what they're doing in those buckets.
Right. Yeah, we want our clients to have real clarity on what we're doing with their assets, and explaining how and why we have allocated things the way we have, I think is part of providing that clarity.
Yeah. Well, perfect. Thanks, Doug.
All right. Thank you, Jay.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.